Hello everyone. In the earlier session, we discussed about some of the basic aspects related to the head of income, salaries, and the core criteria on the basis of which an income can be taxed under this head is the relationship between the payer and payee, which should be that of an employer and employee. And if that relationship exists, then only the income that is received by the payee shall be taxable under this head. And in some cases, even though the relationship is existing as an employer and employee, still the income may not be taxable under this head, because that income may be an additional income which is not pertaining to the general duties that are performed by the employee. Some of the examples which have been already decided in the courts of law have also been discussed. For example, a lecturer earning any money by way of being a paper setter or an invigilator or a valuer of the papers probably would have been received from the same employer, but still it is not taxable in the hands of that employee as a salary, since it is not the regular income that he is earning by performing the regular duties. Of course, there can be much more gray areas and subtle differences. For example, if the question says a lecturer has set the paper for the internal exams of the college in which he is working, and for that the college has paid him some honorarium or fees, whatever you can call it. In that case, will it be taxable in the hands of that employee as salaries or not? In that case, the answer would be yes, because for all the normal duties like setting the papers, being an invigilator or being a valuer for the internal examinations is part of his job in general. So that is fulfilling the criteria for that income to be taxed under the head of salaries. However, if the same person is doing these tasks over and above his normal duties, then the same will be taxed under income from other sources. Of course, as I said already, these are gray areas, which means there can be always the arguments on both the sides. There will be always a possibility to argue that how can it be this way? It could be the other way also now. Yes, it could be the other way also. But it could be this way also. That is why it is gray area. That is why judgment is required in certain circumstances like that. Of course, if the courts have already decided, then we cannot judge it again. We don't have that capacity. We have to just follow the judgments which have been already given. The judgments like income of MPs and MLAs shall not be taxable under the head of salaries, but it shall be taxable under the head of income from other sources. That we have to follow. Though the money can be given to MPs and MLAs by name of salary, but it cannot be taxed under the head of salaries. Similarly, any commission received by consignee from the consignor shall be taxable under PGBP, but not under salaries. Like that. Depending upon each case, we need to be applying some judgment to decide whether a particular income is taxable under this head or not. Of course, in examination questions, generally such situations do not arise. Why? Because the question itself will be clear that SASI is working for somebody, which means automatically the incomes which are mentioned in the problem will be taxable under the head of salaries. So for problems and solutions, generally that's not a crucial thing to be able to differentiate and to be able to identify whether an income is taxable under the head of salaries or not. It takes few seconds to identify that. But if special cases are asked, there definitely little bit of thought has to be given, little bit of logic has to be applied, and accordingly we need to give our answer, which is basically the judgment according to us what it is. But that cannot be arbitrary. It has to be on the basis of certain previously decided cases. So if the questions are coming from those examples which we already know, there is no need of a fresh thought also, because while learning itself we already thought about them. But if the case is altogether a new one, then definitely in the examination conditions you might have to apply a bit of logic and imagination for arriving at a practical solution to that case. Though it is exceptional, it is quite possible to have such questions in the examinations. Such questions were asked in the earlier examinations also, asking the students to identify which head of income will be attracted in relation to a particular income earned by an SSE. In that, definitely salaries is also one of them. So we should know certain things as incomes taxable under this particular head, and we should also know certain things as incomes taxable under some other heads. Though we don't know that heads of income in detail, by now we already know that MP MLA salaries will be taxed under income from other sources, like that. So these are the basic things we discussed already in the earlier session. Now let us continue this discussion of, let us say, the scope of this head of income salaries and what is the structure of this head and how are we going to approach our learning process in relation to this head of income. But before that, there is one more point here, particularly related to partnership firms. There is a very specific point to be noted, that any salary, bonus, commission or remuneration, by whatever name called, salary, bonus, commission or remuneration received by a partner of the firm from the partnership firm, name looks like salary, name looks like remuneration, looks like it should be taxable under salaries, but it is not taxable under salaries, it is taxable under PGBP, profits and gains of business or profession head. That has to be always remembered. This is a decided case, so we don't need to freshly apply any thought on that. However, we don't have to leave it also. Why it could have been decided like that? Just because one reason, the partner being the owner of the partnership firm himself cannot be called as an employee of the partnership firm. Though it is quite possible that only few partners might be getting salary as working partners and some dormant partners might not be getting salary. So it looks like the working partner is actually an employee of the partnership firm and whatever remuneration that he receives ideally should be taxable under salaries. It looks like that. But the reality is no, it is not like that. Very clearly, in the Act itself it has been given as a provision which has been also confirmed by the courts, that any salary, bonus, commission or remuneration received by the partners from the partnership firm is not taxable under the head of salaries, it is taxable under the head of PGBP. Once again, the reason could be the judgment in the way thinking about partner not as an employee of the firm but as a owner of the firm. So there is no employer-employee relationship between the partner or the firm and the partner. Employer is not the firm is not the employer, partner is not an employee. basically he is the owner, one of the owners, but definitely is the owner. So the employer-employee relationship is missing very simply there. That is why whatever the remuneration the partner receives from the firm is taxable, by the way. It is taxable, but not under the head of salaries. It is taxable in the head of PGBP. But because now the topic has come, we need to be aware of certain other things also. Like for example, the profit share that is received by a partner from the partnership firm, how about that? Where will that be taxable? Answer is, it is not at all taxable. Why? Because it is exempt from tax. Why is it exempt from tax? That is extra. Exempt from tax, the law already said. We can take it blindly. But just for curiosity purposes, why could it have been exempted? The reason is, since the firm is already an SASI and firm would have already paid tax on the profits that it has earned, and the profits which are distributed to the partner are the profits which are arrived at after paying the tax. So the profits after tax are distributed to the partners, which means the same income cannot be taxed once again in the hands of the partner, which would be unfair if it is done so. That is why the share of profit received by a partner from the partnership firm is exempt from tax. It is not at all taxable. Whereas salary, bonus, commission, remuneration received by a partner from the partnership firm is taxable, but not under the head of salaries, though the name indicates that it will be taxable under PGBP. Very important point to note always, because this will be appearing in some of the problems. Even in PGBP chapter actually, not in this chapter. But we should know that if any salary is received by a partner, it is taxable under the other head, that is PGBP, but not under the head of salaries. Now, the question comes, can we apply these logics everywhere? No. Answer is no. We have to be very clear on one thing. In order to understand why a particular judgment would have been passed or what could have been the intent of the statute while understanding a provision, we might apply a logical approach to just understand that provision or that judgment. That does not in no way mean I will apply the same logic everywhere. No, that will be wrong. For example, what we just now understood, the salary received by a partner from the partnership firm is taxable under the head of PGBP. And we had a fantastic logic for that because there is no employer-employee relationship between the firm and the partner. Fine, fantastic. But next question comes. What about the salary received by the managing director of a company from the company? So the managing director of a company, who is a director first, then he is a managing director, and he is receiving some salary from the company. What about that? Mukesh Ambani receives salary from Reliance Industries Limited as a CEO of that company, Chief Executive Officer of that company. Question comes, what about that salary? Whatever the amount it may be, definitely runs into crores of rupees. That salary, is it also taxable as PGBP, applying the same logic? No. There the logic will be different. There we cannot use the partnership logic. There we have to apply the company's related thought process. First of all, in case of partnership, though the law never expressly told it, but the definition of the partnership itself, one way, tells that the partnership firm and the partners in general are one and the same, but for the purpose of Income Tax Act, there are two SSEs. So individually the people are called partners, collectively those are called firm. That is the definition of partnership in the Indian Partnership Act, which is adopted by Income Tax Act also. That is a completely different status as a partner of a firm. But when it comes to the company, company is altogether, always, in the eyes of law, a separate entity. Not only in Income Tax Act. Even in the Companies Act also, the company is a separate entity by itself. Which means, Mukesh Ambani is completely different from Reliance. So when he is the CEO of that company, he is receiving salary from that company. Why is he receiving? Is that in the capacity of a shareholder of Reliance? No. He might be the major shareholder in that company, no doubt. But he is not receiving this salary in the capacity of being a shareholder of that company, but rather he is receiving this salary in the capacity of being a CEO of that company. That is the difference. So he is not receiving as a owner. He is receiving it as an employee. So CEO of that company is an employee of the company, and that is definitely taxable under the head of salaries. So the remuneration received by managing director, CEO, whatever the name they are called, it is taxable under the head of salaries. There we will establish employer-employee relationship between company and MD. Both are not one and the same. There is employer-employee relationship between them. But when it comes to partnership firm, between the firm and the partner, there is no employer-employee relationship. That distinction we need to identify. There is a lot of distinction between these two items. Treatment-wise also there is distinction. Legal position also there is distinction. That is an important point always to note. These are conceptual things actually. Throughout the income tax learning, these points will be helpful for us. So what is the lesson to be learned from this discussion is, we can understand certain provisions and judgments using some logic. At the same time, that does not give us free hand to use the same logic in all circumstances according to our whims and fancies. That is not possible. Each circumstance is different. Partnership firm and partner relationship is different. Company and managing director relationship is different. Now because the topic of the company has come, there may be other incomes also that Mukesh Ambani receives. Quite possible. Just for imagination. We don't know exactly, but just for imagination, let us say Mukesh Ambani has given some loan to the Reliance company. So, company taken some loan from the shareholder or director. And Reliance, let us say, pays some interest to this person. In that particular scenario, the relationship once again has changed. There, he is not employee of that company. He is the lender to the company. So when he is a lender and he is receiving interest on the amounts that he has lent to the company, that interest will be taxable under income from other sources. Again, head difference has come. Same person, same company. Payer is same, payee is same. But what we have to identify very carefully is, incomes are not taxable in the same head. Same Mukesh Ambani receives salary. As a CEO, such income is taxable under the head of salaries. Same Mukesh Ambani receives interest, then that will be taxable under the head of income from other sources. And of course, definitely the same Mukesh Ambani also receives dividend from the Reliance company. That will be also taxable under income from other sources, to the extent which it exceeds 10 lakhs rupees. Because up to 10 lakhs rupees, definitely it is exempt. We know that. And we also can easily imagine Mukesh Ambani will definitely receive more than 10 lakhs rupees as dividend. It's a huge company we are talking. So crores of rupees he will receive as dividend. In that, up to 10 lakhs, nothing will be taxable. Beyond that, it will be taxable flat rate of 10%. So the point is, person is same, the payer is same and the payee is same, but still the incomes what the SSC is receiving are being received in different capacities. When he receives salary, he is an employee of the company. When he receives interest, he is the lender to the company. When he receives dividend, he is a shareholder to the company. So, capacities are different, heads of income are also different. That is the point we have to identify. And we need to apply the logic related to a particular situation only. We cannot universally apply everything to everybody. That is a point to be always noted. Then a question comes, sir, what about sole proprietor? Sole proprietor also might receive some salary from the business what he is running, and we know in accounting the separate entity concept which says business is different from the owner and all that. So, will that salary received by a proprietor from the proprietorship concern also be taxable as PGBP, just like partnership? Answer is again no. First of all, the Income Tax Act does not give any cognizance to the concepts of accounting we follow normally. If it gives any importance to that, if it gives, then only we should identify that it is giving. But we cannot expect it to give. So normally what happens is, more than accounting, practically this Income Tax Act uses this substance over form. Form doesn't matter. Substance matters. Once again, if you look at the form, salary received by a partner looks like salary. Looks like that. But what Income Tax Act says, no, it is not salary. It is PGBP. Same way, salary received by a proprietor from the proprietorship concern which he only owns looks like salary, but it is not. Then the question comes, what it is if it is not a salary? Answer is, it is nothing. Income Tax Act actually does not recognize any notional items. That we need to keep in mind. In the basic concepts, we discussed it. If a sole proprietor says that he himself is giving a salary to himself, that is all not recognized as a transaction also by Income Tax Act. In accounting, I will pass an entry, salaries account at R2 capital account. You can pass 100 entries. Doesn't matter. That is accounting. Is that valid in income tax? No. Answer is no. Strictly no. That entry has no relevance at all in Income Tax Act, which means any salary that is received by a proprietor from the proprietorship concern cannot be taxed at all. It is not having the nature of income. It is not even income first. First of all, if it is income, then the question comes whether it is taxable, not taxable, something else, discussion about exemption, something else will come. It is not income at all because it is notional. It is not real. One simple concept once again. Go back to the concepts of income tax and concept of income that we discussed. One cannot earn income from oneself. Not possible. Even if it is happening, Income Tax Act does not recognize that as income. So as far as Income Tax Act is concerned, the thumb rule is one cannot earn income from oneself. So, a proprietor taking a salary from his own proprietorship firm, a proprietorship concern, doesn't make any sense under this act. It is not at all income. So it is not at all taxable. The question of which head of income it is taxable does not arise. When it is not taxable, then head of income is irrelevant. Nowhere it is taxable since it is not even an income. So that is a point to be noted. But in these all circumstances, our understanding has to be little more comprehensive. Now we are talking about salary given by one entity, whatever that entity could be. It could be a proprietorship concern, it could be a partnership firm, or it could be a company. Let us take three major types of organizations. In these three cases, the organization is giving salary to an individual because that individual is working as an employee. That's what they are saying. But if the salary is given to A sole proprietor, we just ignore it. That is not even a income. If the salary is given to partner, then such salary received by the partner is taxable. There we are not calling it as partner earning income from himself, because he is not the only guy. There the organization has a little bit more different entity concept than proprietorship. Proprietorship means that is his soul and soul. Whole and soul, entire ownership is belonging to one person. Partnership means ownership is not belonging to one person. So at least Income Tax Act is giving a little bit of recognition to the separate entity concept of partnership, but not to sole proprietor. Of course, company is always a separate entity in all circumstances. So that is why salary received by CEO of the company would be taxable under salaries only, under this head only. Like these three different treatments are to be given under different circumstances. But now look at the organization side. We were only talking about the individual's side who has received this income. But who is paying this money is organization. Now definitely organizations, all of them, whether it is a sole proprietorship concern or a partnership or a company, all their incomes would be taxable. That organizational income will be always taxable under PGBP because they are doing business. That's what business is about. So definitely those organizations' incomes are all taxable under PGBP. But we are not bothered about income here because the organization is giving the money, not earning the money. Individual is earning the money, which is given by an organization. So for organization it is not income, it is expenditure. When it is expenditure, the question of taxability does not arise because taxability is about incomes. Expenditures are not to be looked at for taxability. But another question arises, that is called deductibility. Whether that expenditure is deductible, that question arises. For simple understanding, what is deductibility? Let us say any organization, when you prepare a profit and loss account, you have sales on the credit side, whatever it is, trading and profit and loss account. There is no distinction in essence. It's only presentation that matters in accounting. So let us not mix those things unnecessarily here. So basically income or revenue is credited to the P&L account. Expenses are all debited to the P&L account. The resultant of this is called profit. Means what? Simply, instead of an account format, if you imagine a normal calculation format, what is profit? Nothing but revenue minus expenses. Once again, specifically referring to the Income Tax Act, what is income under this act? Is it revenue or profit? No, it is not revenue. It is profit. That also we earlier discussed. Important concept, always to keep in mind. Income is a net concept, not a gross concept. So, when we talk about any business having revenue, minus some expenses, whatever the resultant is there, that is profit and that is what we call as income and that is what is taxable. So when we say minus some expenses, those expenses are what? Deducted from the revenue. Now the question comes, all expenses will be deductible? No. That is why we have a chapter called PGBP, which tells us what kind of expenses will be deductible, what kind of expenses will not be deductible. Means, in other words, what expenses can be reduced from the revenues to arrive at profit, what expenses cannot be reduced from the revenue to arrive at profit. And this has nothing to do with accounting. Conceptually, both are same. Revenue minus expenses is equal to profit, which is income here. But treatment is not same. There may be expenses which can be debited to P&L, but in income tax, those may not be considered as expenses only. Examples are the same things what we are talking about. Now let us take one by one. First let us take company. Let us come in reverse direction. Company, what was the situation? Company paid salary and CEO received salary, and whatever salary that CEO has received, it was fully taxable in the hands of that person as salaries, under the head of salaries. Done. But for the company, what about it? For the company, the same amount is expenditure. Let us say Mukesh Ambani receives 40 crores rupees salary in a year. Imaginary number. Don't Google it, unless you are interested in knowing about it. So, imagine he receives 40 crores salary from Reliance as a CEO. That would be taxable for him as salaries, under the head of salaries directly. Then the question comes, what about the same 40 crores for Reliance? Since it is expenditure, would that be deductible? Of course deductible. It is deductible, because is it a genuine expenditure of that company? Yes. Just like it is paying salary to many other employees, it is paying to the CEO also. No difference. So just like any other expenditure is deductible, this is also deductible. So no problem. Straightforward thing. So for the company, there is no issue. Which means the expenditure in the form of salary paid to CEO is deductible for the company, and the same amount which is earned by the employee who is the CEO is taxable under the head of salaries. That is the position in that case. Second case, partnership firm. Partnership firm also paid some salary, let us say, to a partner. Paid. For the partner, it was taxable. Yes, it was taxable. It's a different story. It is taxable under the head of PGBP for the partner, not salaries. Doesn't matter. Anyway, it is taxable. Definitely, yes. Now the question comes, what about the firm? For the firm, it is an expenditure now. Yes, it is an expenditure. It is an expenditure. So should it be deductible from the firm's revenues? Yes, it should be. Is there a deduction? Yes, there is a deduction. Of course, contained in the PGBP chapter, section 40B talks about that. We'll come to that later in that chapter. But now what we are talking about is the concept, not the provision itself. So as an expenditure, is it deductible from the firm? Yes, it is deductible. But point is, because Income Tax Act has restricted the amount of deduction, it is not fully allowed as deduction. Sometimes it may be a lesser amount than what has been actually paid by the firm. Why is that? Because Income Tax Act said that, where in the chapter of PGBP, section 40B, which we will learn later. What is the restriction? We don't need it now. We will come to that later. But there is restriction, that we know. That's enough for now. We know that the partnership firm cannot pay as much amount as a salary it wants to the partners. There are some restrictions on that. According to those restrictions, whatever is allowed, that much only can be deducted from the revenues. So what we call that? That is what we call deductible. So these words are important. When we say taxable, definitely we are referring to an income. When we say deductible, definitely we are referring to one expenditure. Sometimes it is fully deductible, like in the case of companies. Sometimes it is not fully deductible. There may be certain restrictions, like in the case of partnership firm. So what is the position of partnership firms now? For the partnership firm, the salary paid by the firm to the partners is deductible. Yes, it is deductible. Star conditions apply, subject to section 40B, subject to the restrictions, whatever those restrictions may be. Then how much amount is taxable for the partner? We know it is taxable under PGBP, but how much? For example, a firm pays 10 lakhs rupees salary to the partner. Example, as per 40B, it cannot pay more than 8 lakhs. What is 40B? That we don't know. But according to 40B, let us say the firm is not supposed to pay more than 8 lakhs. But it paid 10 lakhs. Can the firm debit its P&L account with 10 lakhs? Answer is no, because it is not allowed. Under Income Tax Act, 8 lakhs only is allowed as deduction. So firm can deduct only 8 lakhs from its revenue to arrive at profit, not 10 lakhs. 2 lakhs is not deductible. Sometimes it can be called as disallowed. Allowed means allowed as deduction. Disallowed means not allowed as deduction. So the 2 lakhs is disallowed. 8 lakhs is allowed. These are the words we use. We have to be very careful with words. Or otherwise we can say deductible, not deductible. That is an alternative. Deductible how much? 8 lakhs. Not deductible how much? 2 lakhs. That is from the firm point of view. That is clear. What about partner? He actually received how much? 10 lakhs. Now naturally the question comes. How much will be taxable for the partner? We know it is taxable under PGBP. For the partner also as an individual, it is taxable in his hands under the head of PGBP. That is clear. Question is not that. Question is how much? How much is taxable? 8 lakhs or 10 lakhs? Here where logic has to be applied. Law will not be telling everything. It should be 8 lakhs only, right? When on the other side of the coin, the law only allowed a deduction of only 8 lakhs, how can the law say for the recipient it is fully taxable? Not possible. So what is the lesson now? How much will be taxable in the hands of partner? That much will be taxable in the hands of partner as it has been allowed as deduction under 40B. How much ever is actually allowed for the firm as a deduction, as an expenditure, same amount will be taxable in the hands of partner also. So the point here is, though the partner received or claims to have received 10 lakhs rupees from the firm, how much will be taxable? Only 8 lakhs will be taxable. This is where generally some people unnecessarily get confused or mix the things up. Sir, what happens to that 2 lakhs? Nothing happens. The law doesn't recognize that. So always there is a possibility of difference between the reality and what the law recognizes. Reality could be 10 lakhs. Reality could be 10 crores also. We don't know. We don't care. What the law recognizes in that, according to our example, it recognized 8 lakhs as an expenditure for the firm. So definitely it recognizes the same 8 lakhs as income for the partner. That is a very important point also to be noted. These are all linked with each other. Logic is linked with each other. So we are discussing all of them at one time. Though they are not really related with the head of income, these concepts are important throughout the act. Whenever we learn income tax, these are the core aspects. Because in general, there are only 3 major SSEs. If you look at general statistics also. Who will be there in the major number of SSEs will be what categories? Majorly individuals, then maybe companies, then maybe partnership firms. That's all. Majorly these are the people. So we need to know the entire cycle of that. Not just one side of the coin. We need to also know the other side of the coin. What is the treatment for the SSE as an employee and what is the treatment for the organization as an employer? Both we are learning at the same time now. Though employer part is not related to this head, though it is related to PGBP, which will come later. Concept we should know in advance. Provisions we will come to know later. Now, coming to the third category, that is sole proprietorship. Same story. Proprietorship concern is there. As an employer, it has paid some salary to the proprietor itself. So, what is the position there? One side we already know. Employee, first of all the proprietor, it is not taxable because it is not even income. We just actually ignore it. We don't even consider that as income since it is a notional income. Now the question is about other side. What about the proprietorship concerned? The business also will maintain its own books of accounts. In that, can it debit this to its P&L account? In accounts you can. You can do anything in accounts. That is your choice. You can just have a journal entry and everything is fine there. But not in income tax. Here, it is not allowed as deduction. Same thing. Logic is still the same. If an item is not considered as income for the sole proprietor, how can it be considered as expenditure for the other party? When there is an income for somebody, there is an expenditure for somebody else, right? There are two parties. Income and expenditure are just two sides of the same coin. Transaction is only one. But that transaction has resulted in income for somebody, and the same transaction would definitely result from an expenditure to the other party. That is clear. But the point is about treatment in the income tax. So here, because it is not treated as income, for the sole proprietor in his individual capacity, the same amount cannot be given as a deduction also for the sole proprietorship concern. That is the organization we are talking, the business we are talking. Once again, the reason is same. Substance over form, though looks like sole proprietor and the sole proprietorship concern are different, though there may be a accounting concept called separate entity concept, we don't recognize that concept. We just ignore that. In other words, this is a very important point, always to be remembered. Always, throughout the act, we have to remember this very important point. As far as Income Tax Act is concerned, we don't distinguish between the sole proprietorship concern and the sole proprietor. Here, business and individual are one and the same. That is why, in the definition of the SASI, we have individual. So, individual is our important point, not business. Imagine one proprietor, one individual has 4 businesses. One individual has 4 businesses. Question comes, will there be 4 assessments? Answer is no. There will be only one assessment, because assessment is not for business. Assessment is for the SSC. And who is that SSC here? Individual. He may have 40 businesses also. Still we don't care. Ultimately assessment is only one. Taxability arises in the hands of that individual. How many businesses that individual has is irrelevant. So for that business, this is not a real expenditure if it pays any salary to the proprietor, since it is also a notional expenditure. So same way, as notional incomes cannot be taxed, notional expenditure cannot be deducted. So ultimately, that expenditure, if at all, it is claimed to be an expenditure by a sole proprietorship firm. Sole proprietorship firm I am using, don't mix firm with partnership firm always. Firm is a generic word. Companies are also called firms. Anything can be called a firm. But particularly, when it generally doesn't use any other prefix or suffix, then we just call it a partnership firm. So not necessarily every time we say firm, it is only partnership firm, but in general, yes. So sole proprietorship firm is not something which is a bad usage. It's normal. Any firm. Firm means an organization, that's all. Not in the sense of a partnership firm. So if a sole proprietorship firm pays salary to the sole proprietor, what is the final treatment? It is not taxable in the hands of the sole proprietor, since it is a notional income, and it is not deductible for that sole proprietorship firm, because it is not a genuine expenditure, it is a notional expenditure. That is a very important point to note, both sides of the coin. So all of them are linked with each other. That is one discussion in relation to 3 different kinds of organizations. Now coming back to the head of income salaries, what is the definition of salary, which has been given in section 17.1. Section 17.1 defines what is salary, which includes, if you read the definition of salary, which has been sent to you already, you don't need to by heart it. Don't try to by heart it. Just go through that generally. Essence is enough. We don't need to remember all those things. What is required to be remembered, I will tell you. Those things you remember, that is enough. What salaries include? It includes wages. It includes any pension or annuity. Annuity is also a kind of pension only. There is no difference. Pension is a kind of annuity. Actually, annuity means any periodical payment is called annuity. So it's a generic word. But in general, it is used in the context of post-retirement benefits, which we also call pension. So that is also salary. In other words, these 2 points, what they will tell us? They will give us some, I would say, between the lines information. First of all, unlike accounts, here we don't distinguish between wages and salaries. Sir, wages I debit to trading account, salaries I will debit to P&L account, that's what I know. Very good. Nothing wrong, you know. You know perfectly well. That is perfect. Good. But where? In accounts. Don't bring that here in taxation. Here, there is no distinction between wages and salaries. Both are taxable under the head of salaries only. We don't have to even think 1 second also. What is the treatment of wages? What is the treatment of salaries? No difference. Both are same. Once again, referring to substance over form. Wages is a name given. Salaries is a name given. We don't care about the names. Essence is what? There is an employee who is working. There is an employer who has employed him. And employer is giving some money to the employee. Name it could be anything. He can call that wages, he can call that salaries, remuneration, he can call it honorarium, whatever names given. Names we don't care. That is the essence we have to understand. Names do not matter much. Essence matters for the purpose of Income Tax Act in general. So wages is also salaries. That is taxable here under this head as clearly defined by the Income Tax Act under section 17(1). Pension is also taxable under the head of salaries only. So once again, that tells us also some other information. So what does it tell us? What can we infer from that? Because very clearly it is telling it is taxable under the head of salaries. Very clearly defined itself. In the definition itself they included pension. So what is the meaning of that? What is the message conveyed there? Message is, boss, we said there is a requirement of employer-employee relationship between the payer and payee, but we never said that should be existing. That the law never said. In other words, what is pension? Pension is some periodic payment received by the employee from his past employer, not from the current employer. He is not working, no, employee has retired, then only he receives pension. So, question is, when an employee receives pension, at the time of receipt, is there an existing employer-employee relationship between payer and payee? Answer is no. Still it is taxable under the head of salaries. Why? Because we don't care about the employer-employee relationship to be existing now. That was not mentioned in the law. Law said there should be employer-employee relationship. Enough. It never said it should be current relationship. No. Somebody might receive money from a past employer, still taxable under the head of salaries. Somebody might receive money, not pension, something else, from the prospective employer, future employer. Still it is taxable under the head of salaries. Somebody might receive something from the current employer. Still it is taxable under the head of salaries. So the essence what we can draw from here is, there is no need that the employer-employee relationship should be existing now in the previous year. That is not required. There should be employer-employee relationship. Was there any such relationship in the past? That is enough. Or maybe is it going to be some relationship in the future? Still no problem. That is enough. If it is existing, anyway there is no problem. So, wages is also taxable. Name doesn't matter. Annuity pension also taxable. The timing of the relationship of employer and employee doesn't matter. Gratuity is taxable. Gratuity is generally a lump sum payment upon retirement, which is generally given by the employer to the employee in general for the appreciation of the services what he has rendered all these years. We'll come to that. There is a separate topic on that. But basically it is a lump sum payment. It's not a periodical payment. Generally what the words salaries, wages, pension, these are all periodical payments. Monthly in general they will be paid to the employees. But gratuity is not like that. Gratuity is a lump sum payment. So, still it is taxable under the head of salaries. So what lesson we can draw from that? Because there is no need for any payment to be periodical in order to be taxed under the head of salaries. Like that there is no rule. Even lump sum payments are taxable if it is mentioned by law. If the law says it is taxable under the head of salaries, that's it. It is taxable under the head of salaries, even though that amount is not a periodical payment. Even though it is not received periodically by the SASI, still it could be taxable since the law says it is taxable under the head of salaries. That is gratuity. Taxable here only. Any fees, these are all words which are used by different people creatively. Or there may be 100 other words also. Actually we don't need the names. But what are the name called? Fees, commission, profits in lieu of salary, profits in addition to salary or wages, or perquisites, all of them are taxable here only under the head of salaries. That's it. But there is a word here, perquisites, which is nothing but a facility given by the employer to the employee, which is not a cash form, which is a facility form. In other words, we can say it is a benefit given by the employer to the employee in kind, not in cash. Normally salary, wages, these are all money. Once again, some people are thinking cash means bank transfer is also okay. No, there is no problem there. Cash does not mean currency. Okay. So cash is different, money is different, currency is different. A lot of differences are there. So we don't have to unnecessarily bring our own additional thoughts when we say cash. So when we say cash, that includes everything. That includes currency or bank transfers. Both are same here. So in accounts we write cash in hand separately, cash at bank separately. Once again, that is accounts. Here we don't distinguish. Cash also, bank also, both are same as far as when the reference to the word is concerned. So the point here is, when anybody earns some salary, that is periodical and that is going to be generally in the form of cash, some money is received from employer. If the employee is not receiving any money, rather he is receiving some benefit from the employer. For example, let us say employer gives an accommodation to the employee so that the employee can stay in that. What we popularly call as quarters. Employer gave a quarters to the employee for staying. What can we call that? That can be called as a perquisite. Like this, there are so many perquisites. We will see that segment also in this chapter. Point is what to be noted here. What can we infer from this point, because it is included in the definition of salaries, is there is no necessity that the salary has to be in cash. Even anything received, any benefit received, amenity, facility received in kind, also taxable under the head of salaries, because it is included in the definition of salary already under section 17(1). That is the inference we can draw from that fourth point. Then, fifth point says any advance of salary. Advance of salary is also salary. We'll come to this little bit more discussion required, because there is a difference between advance of salary and advance against salary and all that. We'll discuss it in a separate session. But understand the concept here. Point is there any necessity that the salary has to be really received? No. If it is earned, that is enough. Is there any necessity that salary has to be really earned? No. Received, that is enough. Income Tax Act, at least by now you could have understood. Earned also, received also. Both are recognized as income only. Something earned but not received, still taxable. Something received but not yet earned, still taxable. So advance salary is falling in which category? It is falling in the second category, which is received but not yet earned. We don't care. Still we say it is taxable. So advance of salary also is taxable under the head of salaries. It is included in the definition of salary under 17(1). And sixth point is about any payment received by an employee in respect of any period of leave not availed by him. So any leave, if the employee has not availed during service, usually at the time of retirement, he can encash that leave. This is popularly called as leave encashment, or we can call it as leave salary. We have special provisions related to them. We will come to that. But right now what we can understand is leave salary is also taxable. That's it. Leave encashment received by employee from the employer is also taxable under the head of salaries, since it is defined in the definition of salary. That is sixth point. Seventh, eighth and ninth points are not new, if you can observe them. These are the same things that we discussed in the residential status tax incidence chapter, wherein these were all called as deemed to be received. Section 7, deemed to be received, is the same thing what we have here also. Why we are deeming them to be received? Because they are not received also doesn't matter, still they become taxable. They are deemed to be received. Like what? Employer's contribution to a recognized provident fund in excess of 12% of salary Same way, interest credited to the recognized provident fund in excess of 9.5% per annum. Similarly, the balance transferred from unrecognized provident fund to a recognized provident fund. Same way, contribution by the central government or any other employer to any pension scheme which has been particularly notified in section 80 CCD. In all cases, employer is contributing something to the employee's provident fund account. In other words, he is not giving money directly to the employee, but on his behalf, employer is depositing in the provident fund account of employee, which is still treated as salary. That is the point. But how much is treated as salary? How much is taxable? How much is deemed to be received? Only in excess of 12% of salary, which is contributed by employer. Like that. Same way, any contribution made towards a notified pension scheme, that also shall be taxable as salary for employee. There you cannot say, employee did not receive it now. How can it be taxable? It is still taxable because it is deemed to be received. So it is taxable. All those 7th, 8th and 9th points already discussed earlier. That's it. That is the definition of salary under section 17(1). Of course, this list is not exhaustive. How do we know that? Because the definition of salary itself states that the word salaries includes. Salary includes. That's an inclusive definition. Always the law keeps its options open. We know that. Same way, this definition is also not an exhaustive definition. It is an inclusive definition. Anything else also can be included here according to the government's convenience. So that we don't have to worry too much about it. That is a judicial matter. But in general, any inclusive definition is just open-ended. Exhaustive definition is closed-ended. If you remember the definition of India, we never said India includes. No, not possible. That cannot be a definition of open-endedness. That's a closed-ended definition. Means the definition itself uses the word means. So if you remember the India definition, it says India means. It will not say India includes. But here the definition of salary is saying the definition of salaries. The salary includes is the word used, which means it is an inclusive definition. That's all. Nothing more than that. And already some of us might be thinking why it is defined under section 17(1). Why could not have it been defined in section 2? Because usually any act will contain all the definitions in section 2, which we have some of the definitions like what is the definition of SSC, what is income, who is a person, what is India, what is assessment year, what is previous year. All these things were defined in section 2. Why the hell it is defined now under section 17(1)? Genuine question. Answer? No answer. Because it is not you and me who is going to decide where something has to be defined. It is the discretion of lawmakers. We need to understand that. So certain things like that cannot be questioned. Doubt might come, but we should answer ourselves also. That was a stupid question. Means, who are we to decide? They will define everywhere. They will create one section number 2442. We don't know. That is their whims and fancies. Whatever they want to do, they can do. That is the power they have. So we need to understand that first, recognize that first. We cannot expect the law to follow all the logics and our own great thought process. It would have been better if it follows, but we cannot expect that. Not necessarily. So the point is, we are not the ones to understand, or we are not the ones to dictate where a certain thing has to be mentioned in the act. If it is mentioned in section 2, we will say that those are all definitions. If it is defined somewhere else, we will say that that is also a definition. It's a definition is a definition. So we don't have to differentiate that. So here the definition of salary is very clearly given in section 17(1). So that is the explanation for definition of salary. And all these things like additional points Some of them we have already discussed earlier, basic concepts also, and common sense things also. Like for example, salary, should it be in cash or can it be in kind also? Doesn't matter, anything is okay. So it may be in cash, it may be in kind also. If it is in kind, that's what we call it as perquisite. Again, that name also doesn't matter. Ultimately, it is all taxable under the head of salaries only. Then, should the salary be received only from one person? Means should there be only one employer for an employee? Who says? Who are we to tell that? We cannot tell that. Which means an SASI might receive the salary from more than one employer. Still it will be, all those things will be taxable under the head of salaries only. So not necessarily. Nobody said salaries means, our imaginations we cannot impose. Nowhere in the law it said salaries means it should be earned from one source only. No, nothing like that. It can be earned from multiple sources, multiple employers, and even we can add one more point. It could be part-time also, it could be full-time also. Nobody said salaries means it should be earned by working full-time. No, we are not the ones to decide that. It can be part-time also, it can be full-time also. Anyway, it is possible. It can be in cash also, it can be in kind also. It can be from one employer also, it can be from multiple employers also. All of them are taxable without any problem. So we cannot impose certain additional restrictions ourselves, because the law has not put any restrictions on taxability of these items. And on the other side, we know that any fictional employment or dummy employment cannot be called as real. See, Income Tax Act does not recognize fictional things. Any income also should be real, any expenditure also should be real. Fictional income cannot be taxed, fictional expenditure cannot be deducted. The same logic is given here. If at all there is a salary from dummy employment, that shall neither be taxable in the hands of the employee, nor it will be eligible for deduction under the head of PGBP for the employer. We discussed it just now. The concept of fictional income and fictional expenditure. Both of them are just ignored. Neither the income is taxable, nor that expenditure is deductible. Example, classic example is remuneration or salary given by a proprietorship concerned to the proprietor. That cannot be called as a real employment. That is an example of dummy employment. So that cannot be even treated anywhere in the Income Tax Act. We have to just ignore that. That's it. That is about some more concepts related to the chapter of salaries. Provisions we have not yet started. We will start them in the upcoming classes. But before entering into the core provisions, we need to be having a proper direction in understanding the head of income, that is salaries, what we are talking about. Now let's quickly go through the example that was given, where we should be identifying what head of income the particular income is taxable, or the question particularly asks about state whether the following emoluments shall be treated as a salary. Answer should be what? Either yes or no. That's it. Of course, we need to know the reason for it. In the exam, if it is asked, we should be able to write the reason also. But right now, let us understand what are the answers for these different cases, whether those incomes are taxable under the head of salaries or not. Answers are yes or no. Reasons, if they are already discussed, I am not going to repeat them. If it is a new thing, then only I will explain. Wages to workers. Yes, it is taxable under the head of salaries. B, second one. Salary received by a partner from his firm. No, it is not taxable under the head of salaries. Of course, it would be taxable under the head of PGBP. We already discussed that. C, point number C. Salary received by a proprietor from his proprietorship concern. Is it taxable under the head of salaries? No. First of all, it is not taxable at all, since it is not even an income. So, answer is no, it is not taxable. Point number D, director's fees. This is a crucial thing. This is a new thing. Director fees is different, director remuneration, the next point E is different. D and E are not same. Director fees is different, director remuneration is different. Director fee means what? That is a fees generally given to the directors for attending the board meetings. Popularly it is also called as sitting fees. They attend board meetings and they receive fees for that. That is not taxable under the head of salaries. Director fee is different. Director remuneration is different. Director remuneration could be taxable under the head of salaries. So, when the director remuneration is given, that is given as an employee of the organization. When director fees is given, person is same. Of course, these both of them will be given by whom? The word director itself comes under which context? Only for companies we are talking, naturally. If a company pays fees to the directors for attending the board meetings, that is not taxable as salaries. That is taxable under the head of income from other sources. If the company pays remuneration to the directors for performing their duties normally, that is taxable in the hands of directors as salaries. That is the difference we need to identify. So, director fee answer is no, it is not treated as salary. Director remuneration answer is yes, it is treated as salary. Then F point. Retainership fees received by a chartered accountant. Interesting point. Retainership fees can be there for other professionals also. Like for example, a lot of companies employ certain lawyers, practicing advocates as their consultants. They retain them as their consultants. They might even give them monthly money. Like that, chartered accountants can be also retained for their services and they can be given monthly, some periodic amount. Standard amount also can be given. That is called retainership fees. That retainership fees, is it taxable under the head of salaries just because it is periodical? Answer is no. It is not taxable under the head of salaries because this is part of the profession which is done by the professional. So it is taxable under PGBP, not under the head of salaries. So retainership fees, though it is periodical, does not qualify to be a salary. Why? Because once again, there is a relationship of client and service provider there, but not employer and employee. An advocate who is on the rolls of the company, who is a in-house legal team of the company, he becomes an employee of the company. Whatever money he receives, that will be taxable as a salary for him. But for a practicing advocate who acts like a consultant, for which he receives a retainership fees, that is not taxable as salaries, that is taxable under the head of PGBP. Same way, a lot of factories even retain some doctors. Doctors, let us say, will be given monthly some amount. And what is the general duty of the doctor according to their terms? Example we are talking is that the doctor comes every week to the factory and performs health checkup to the workers there. That is the job of the doctor. For that, company pays monthly some amount to that doctor. Question comes whether that is taxable as salary because there is a fixed monthly remuneration that is being given to that doctor. Same thing. There also we call it retainership fees. All of them are same, whether it is doctor, advocate, chartered accountant. Concept is same. All are professionals. They are being retained by the organization for performing some specific services and they are being paid a periodic standard amount again and again, recurringly. Because of which it may look like it is salary, but answer is no, it is not salary. It is PGBP. That is point number F. Then, point number G. Pension to a retired employee. Of course, it is taxable as salary because already in the definition of salary itself it is included. Done. Answer is yes, it is taxable under the head of salaries. Point number H. Pension to legal hire of the deceased employee. Here the answer is no. It is not taxable as salaries. Once again I want to remind you, we are not talking about whether a particular amount is taxable or not. That stage is gone. It might be there occasionally, but majorly what is our concern here? Taxable or not taxable is not our major concern. Our concern is, okay, taxable, but under which head it is taxable? Is this taxable under the head of salaries or not is our concern. Pension to the legal hires of the deceased employees is not taxable under the head of salaries. Why? Because, once again, there is no employer-employee relationship. Who is the recipient? He is not employee. Employee already died. expired and his legal heirs are receiving the pension, popularly that is called family pension. So the answer here, whether family pension is taxable as salary, answer is no, it is not taxable as salary. It will be taxable as income from other sources. That will come later. But definitely under this head, pension received by the family members of employee is definitely not taxable. Under this head, it is not taxable. Then point number I, remuneration received by judges. Interesting question. Judges are receiving remuneration. So here all our logics will come, but all of them will fail. What is the logic that we already know? Boss, there should be employer-employee relationship. Okay, let us see. Judges are employees now. They are the ones who are receiving the money, remuneration. Question is, who is their employer? Who is employing judges? Generally the government. Of course, there is a collegium system and all for Supreme Court and High Court, that level. But still, definitely government representation is there. Just because of that, can we say government is employer and judges are employees? Probably no. Or let us extend this. Can we say there is a master-servant relationship between government and judges? Answer is no. Daily we see High Court commenting on the government, Supreme Court commenting on the government. Actually, it is scolding also sometimes. So can we say employer, if at all, we imagine that employer to be government, does that employer in this case have any kind of power, authority on the employee? The answer is no. Why? Because normally if there is a master-servant relationship, the master will tell the servant not only what to do, but also how to do. Of course, these things are all not defined by law. This is only logic. But here, the governments can never tell the judges what to do and how to do also. Judges will be independent from the government. So, looks like there is no employer-employee relationship, looks like there is no master-servant relationship. So, looks like it should not be taxable under the head of salaries. But, guess what? It is taxable under the head of salaries. So, all our logics went wrong. Why, sir? I don't know, sir. The judges gave a judgment about their own salaries that it is taxable under the head of salaries. So, they already decided. The courts have decided that. So, they never bothered about employer-employee relationship here. They said still it is taxable under the head of salaries only. Don't worry. Done. Judgment passed. So, we cannot question that now. We may agree, we may not agree. Doesn't matter. But our disagreement is not going to give us marks. We have to agree only. So, answer is what? Remuneration received by judges. Is it taxable under the head of salaries? Answer is yes. Yes, it is taxable under the head of salaries. Because already courts have decided that. There is no further arguments required between us. No need. Already decided by courts. It is taxable under the head of salaries. So here we cannot apply all our excellent knowledge about master servant and all those things. Will not be working. They become useless. Done deal. Next. Point number J. Remuneration to a teacher of a college for checking the answer sheets of university. Is it taxable under the head of salaries? Answer is no. We already discussed that. It will be taxable under income from other sources. Next point, K. Remuneration to a teacher of a college for checking the answer sheets of the college itself, internally. That is taxable under the head of salaries because generally that will be part of the duties of a teacher, lecturer, professor, whatever you can call. So, that is taxable under the head of salaries, but if the same guy is doing the same work for an university or an intermediate board or ICA, for example, that cannot be taxed under the head of salaries. Not possible. So here it will be taxable under the head of income from other sources. That is the point. If it is done for internal things, then it will be taxable under the head of salaries. So point number J, answer is no. Point number K, answer is yes. It is taxable under the head of salaries. Point L, remuneration of the MP and MLA. We know that already. It is taxable under income from other sources. Point number M, Voluntary payments by employer to employee, of course they are also taxable under the head of salaries. Again, the lesson to be learned here, nobody said the payment given by the employer to the employee should be contractual. There is nothing like that. It could be part-time, full-time, contractual, voluntary, one employer, 100 employers, all these things do not matter. If somebody receives money from other person, enough, that is taxable under the head of salary if those two persons have a relationship of employer and employee. So here, employer gives to employee voluntarily, just like that. Normally he is supposed to pay, let us say, for example, 20,000 rupees salary in a month. Suddenly employer was so happy about employee, suddenly he said, Baba, take this month not 20,000, take 25,000. Extra 5,000 he gave. That extra 5,000 is nothing special as far as Income Tax Act is concerned. It is also taxable as salary only. There is no need that the payments have to be periodic. There is no need that the payments have to be uniform. There is no need that there should be full-time work. There is no need that money should be received from only one employer. All these things are not required. We don't have to imagine them. Law is very clear about it. So answer is yes for point number M. Point number N. Overtime salary, including overtime premium, paid by naturally employer to employee, is that taxable under the head of salaries? Here also the answer is yes. Why? Because this is also a payment from employer to employee. It doesn't matter whether it is regular time, overtime, Sundays time, holidays employee came and worked. All these things do not matter to us. We don't care. It is taxable. Of course, yes. As what? As a salary only. There ends the matter. So, answer once again is yes for point number N. It is taxable under the head of salaries. Overtime salary also is salary. Names do not matter. You call it wages, you call it pension, you call it annuity, you call it fees, commission, or you call it overtime premium. Whatever the name it is given, you call it leave salary, all those things do not matter. Everything is taxable in the hands of employee as a salary under the head of salaries. That's it. That is the scope of this head, we can say. Very important points to note before we enter into the actual provisions of this head. And in the next session, we'll start with some of the key provisions related to this head of income. And till the time, take care. Bye-bye. Thank you very much.